This is the Working Investor. Today we're going to talk about leaps and why I mix it in together with my option selling goal. As you guys know, I'm primarily an option seller because I like to be the casino. I want to be the house and have the odds in my favor. And the whole point is to have the highest amount of odds in your favor. There's something called the rule of large numbers that, like, let's say if you play roulette at the casino, I think that's the game with the spinning thing. So basically, let's say if you bet on red or black, and so you only have a 48% chance of winning because I think there's like one number, I think there's a different color, I think green or something, that you don't win. So even though, like, when you put, let's say, $1,000 and you have you have a 48% chance of winning, you could double that 48% chance. And let's say you double it, double it. If you play it enough times, the law of large numbers are that things will be distributed roughly according to the statistics. So you have a 48% win rate. So the house will actually eventually beat you because they have a 2% gain on you. So when it comes to options, I like to have deltas that are in my favor. And why not? You can totally decide to be a seller and have a win rate of 70%, 80%, 60 to 70%. So when you play enough moves, the law of large numbers statistically will be in your favor. Now, the reason why I do like to buy only leap options, is because there are some benefits to it, and I do feel like leaps, you can also have the odds in your favor. So it is psychologically, it takes a lot of spine to put up a lot of money up front versus, just putting up collateral where you're not necessarily putting up the money, and the theta decay when you sell options works in your favor. Every single day you're getting paid for your time. You're getting theta decay, especially when you do short expirations. There's a lot of gamma and it just speeds up so quickly, and then before you know it, you can get out of your trade. Or even if you do get assigned, you have the stock and you can immediately sell it. Here you got to put up the money right away. So the reason why I like it, here's a few reasons. Let's talk about one by one. So for number one, leverage. Like, you need to talk about leverage. A lot of times people compare real estate to stocks. I wish I saw more people out there online or comparing real estate to options. I think that that's a much more interesting and much more compelling way to compare it to. One of the big benefits of real estate and why people make so much wealth in real estate is the power of leverage. If you have leverage, you're using other people's money, you can amplify your returns, especially if it's a very stable asset that goes up. Most definitely, they say, like, real estate is the way. It's not the rich get rich fast, it's more like the get rich for sure. But I would argue that if you go for massive indices like the S&P 500 or the QQQ, or even if you go for individual stocks, which have more risk, but also less you have to put up in premium, arguably, sometimes. And the most important thing is they have positive drift. Positive drift means that eventually the market goes up and down, up and down, up and down. But if you zoom out and look back over the past 5, 10, 15, 20 years, you'll see that overall the direction is up and to the right. So positive drift. That's what you don't want to stick to companies that are flat. Companies that are flat probably would be better if you do like an iron condor, which I've done. I've done a whole year of just iron condors pretty much. But positive drift companies. So here, let's go back to leverage. So when you do, like, I'll show you some examples of leap options, but I pretty much have a 3-to-1 leverage. I mean, if you want, I can go into the example. I actually put it up on top, my newest leap. So this is one in Amazon. So we'll go line by line. It expires December 18, 2026. I opened it May 21st of this year, right after I closed my Apple. It when I put the trade on, it had $941 to expire days to expiration. Amazon was trading at the time of 182.6. It's very important to record the time you put the leap on, what the underlying is trading for, because that gives you an idea of like above that, like if you're doing good or not. The leap was deep in the money, 150 call. It was a zero point 0.8 delta. So if you notice that the leap is a 150 call, Amazon at the time was trading at 182. So it had $32.60 of intrinsic value in the leap, and the remaining is extrinsic value. So I paid $6,500. But again, bear in mind, of the $6,500, almost about half of it was I'm paying for the intrinsic value where it's in the money. The remaining is the extrinsic value. So my cost basis, if you take 150 leap and you add the $65, it equals to $250. So I understand that if I would ever want to do a poor man cover call to make money, I would have to wait until Amazon goes up a little bit where I could do strike prices of 215 or higher. So that would be my break even. So that's the leap I put on. So let's talk about leverage. If you think about it, Amazon was trading at 182.6. So I would have to put up $18,260 to own 100 shares of Amazon. The whole point of the leap is to enjoy the upside potential. Like if Amazon goes up 18% a year, I would make 18% on my money. But because I'm using leverage, I'm only putting up $6,500. That's about a third. That's roughly a 3-to-1, maybe just under a 3-to-1 leverage. I'm basically leveraging. I'm only paying $6,500. If Amazon went up 18% in a year, I would make 3 times 18%, right? So that would be, let's say, 54% or so a year. So that's how I would pretty much make like almost like 3x or so. So basically there comes the leverage. So as long as you have to be uber bullish, because if you're not, it can really backfire. And we'll talk about that later. So basically going down the line, you get the upside capture. You can have uncapped if you do not do a poor man cover call and short yourself. It doesn't always pay to do the poor man cover calls. People are very into that, especially in the beginning when your premium is like $5 because you're so far out of the money. Like right now, if I did try to sell a call for 215 or 220, expiring 45 days to expiration, I don't think it'd be worth it. So maybe later as you go above the strike price, above the break-even price, you can start thinking about that. There is lower downside protection versus stock to explain in a way, because technically, let's say if Amazon went bankrupt and the stock went to zero, I would lose $18,260 for 100 shares. But with my leap, my max loss would only be the $6,500. So I have less, technically, like in a way, less downside loss if it went bankrupt. So there is a YouTuber out there. His name is Options with Davis. Big plus for him. I recommend his channel. So he talks about something called IV expansion on a downturn. So when the market falls down and it's going down pretty quick, you'll notice that the implied volatility expands. It increases, and because the implied volatility increases, premium becomes richer. It becomes more profitable to be an option seller. So if you put on a leap in a relatively low implied volatility neighborhood or season, so to say, and then when the market's falling down, let's say 10% quickly, implied volatility just expands, and now it's more expensive. But if you want to be a seller, you're on the advantageous side. So if you own the stock and you wanted to sell it, you don't have that benefit of increased implied volatility to sell. But if you are an option holder and it falls down quickly, you do have that expansion, which actually could make your premium, your leap a little more valuable in a way because of implied volatility. So you do have that little buffer if there's a quick downside. Thank you, Davis. Another YouTuber is called Easy Investing. Well, it's an N. my spelling. Easy Investing Income. He talks about that it's good to have a balance between calls and puts, and you shouldn't just. So I have a lot of puts on right now. I'm on the put side of the wheel strategy, and I don't have a lot of calls. I do have a call on. I do have 100 shares of S&P 500 where I do have a call, but other than that, everything else is puts. So I did open up another the leap, because now if the market goes up, then my calls are doing good, and if the market goes down, then then I could open more puts. Basically, you just have a counterbalance to kind of hedge against whatever direction the market goes. Some of your trades are doing good, so not everything is at a loss at the same time. That's what Easy Investing Income talks about in some of his videos. Another benefit is, if you look at the trade, I have $941 to expiration. I'm sorry, 941 days. I think, well, time is money, but I have I have almost 3 years, 2 going into 3 years to expiration. So even if we go down, we have another 2021, 2022 type of situation where the market goes up and then goes down and then goes up again in 2023. I have a long time to be right. So I don't know where the market's going to go. I have no way of knowing. So at least if I'm very bullish and there's positive drift, even if there's geopolitics or who knows what out there, and we have a bad season, I could be wrong for like 2 years, and only on year 3 I could be correct, and that would be enough to, depending on how far up the market bounces. So I have a long time to be right. I have a long time to be right. It's like you and your friends are saying, "Oh, it's gonna rain outside. If it rains, I'll make a bet. If it rains, then I'll get a $10." But you're like, but I could be, you could be right for the next 900 days. If you had a bet with somebody for $10 that anytime the next 900 days, if it rains, you get paid, I think you'd be like, oh my God, even if you don't have any access to news broadcast or anything, I think you pretty much want to say that you'll be right, because you have so many days to be right, and you know it's going to rain eventually. And another good benefit is that people don't talk about this enough. Tax strategies. And again, I'm not an accountant, but there's something called short-term capital gains, which is taxed unfavorably. And there's long-term capital gains, which is if you are in a trade for a year and a day, at least a year and a day, you get taxed at a much lower rate. Depending on your income levels, you may get taxed 0, you may get taxed 15 or 20%, depending on your income range. Look into it, but tax strategy should always be part of your strategy. So if you have a leap option that you have a 3-bagger, let's say I put on $6,500, and then Tesla just pops, and I triple that. I'm not going to have to pay short-term capital gains. I'll pay long-term capital gains if I hold it after a year and a day. If I close it out before that, it's considered short-term. But again, speak to your accountant, look at the IRS laws. So there are some consideration and cons. This is not just like amazing. There's always a gotcha, a gimme and gotcha. So you have to always look at your underlyings. You have to look at the market conditions. Are we in a bull market? Are we in a bear market? Where are the tops? Where are the bottoms? It's hard to know, but what can you predict? What are your indicators telling you? What's the global conditions looking like? What's the expected range? Another big difficulty is the spread. I did notice this with Apple, where I got out of Apple after one day. So even though Apple popped at least $1 in a day, I wasn't able to make a full dollar. I only made 60 cents or $60 if you multiply it by 100 shares, because the bid-ask spread just killed me. Because when you go out really, really far, even if it's a good underlying, you need to look at how many open interests there are per trade, because if there are not a lot of buyers and sellers, especially a lot of times when you go out like a couple of years, not a lot of people are trading things that are happening 2-3 years from now. As you approach closer to expiration, I would imagine there will be more action happening. But when you want to close it very far out, you can definitely get killed with the bid-ask spread, and which I have. I didn't get as much profit as I could have gotten because of that. So don't think it's as liquid. especially as you are far from expiration. You also have to keep an eye on your underlying, like how close you are to expiration. When you own stock, you don't have to worry about expiration dates or anything like that. But with the leaps, leap call options, you do want to keep an eye on it. You don't want to get killed, as you know. When you get 45 days to expiration, you just lose so much that you get killed with theta. I would say even like 90 days, or ideally I'll be honest, I think like for me, I would think like 1 year to expiration. I would try to close it out, in my opinion. But I've only done a few leaps, so we'll see. Because if you look at the difference between 1 year, 2 year, and 3 year, the most expensive is from the first year. But when you compare 1 year to 2 year, you'll notice it's just a little bit more, and 2 year to 3 year is a little bit more. And another thing you have to always keep your eyes wide open is 100% loss. If there's a large drawdown below your cost basis, like for example, I have my leap option was a 150 call. If Amazon drops below 150 and we're getting close to expiration, I lost everything pretty much. So I have max loss is 100%, but max profit is uncapped. So that is a thing. Another thing to consider is have the capital to execute for a profit if applicable. So if you're putting on a leap, make sure that if Amazon, let's say, would be close to expiration, and I paid $6,500, even though my cost basis is $250. Let's say Amazon is at $200, so I'm $15 below my break-even price, and we're about to approach expiration. It's still money. You still have some, instead of losing $6,500, you only have to lose $15 or $1,500, because you can execute the leap when we get close to expiration in over 2 years from now. Hypothetically, if it's trading at 200 and you pay only 150 per share and you're getting a value of 200 per share, and then you could sell that, and then you can offset that loss. So make sure you're doing leaps that if you have the money ready, that if you wanted to execute for a profit, you could, and then right away just sell the leap. You could, if you sell the underlying if you wanted, or whatever you want to do with it, sell calls, etc. But that's something to bear in mind. Don't just put leaps on very expensive stuff if you don't feel like you could execute on it. If you have that option to execute, that gives you another tool in your toolkit. I hope you guys enjoyed. There's so much more in leaps to talk about. I'm not the expert in leaps, but this is something that I've learned, and I'll share it with you guys. Working Investor over and out. Again, use your own due diligence. Take your own risk. I'm not a financial advisor, not an accountant, not a lawyer. Just do your own diligence and have fun.